Okay, now, without further ado, it is my pleasure to introduce today's first speaker, Tony Incalcaterra, Senior Vice President with Ipsos's Audience Measurement Team. Tony, you have the floor.
Thank you, Ellen. It's a pleasure to be speaking to everybody. And as we get started, we just first wanted to thank you for your time, but also to let you know that what we're presenting today is primarily derived from our annual Affluent Outlook survey, which we've been doing for quite some time. It's part of our quarterly barometer series, and these are deep dives really into the hearts and minds of affluent Americans. The U.S. survey is part of Ipsos's 50-market global effort, which provides clients with a total understanding of affluent consumers, so who they are, what they buy and use, how they think, and ultimately for marketers, how to effectively reach them and speak to them in perhaps the most pervasive or persuasive way. Now, over the course of the next 45 minutes, we're going to cover a lot of material, as we always do in these webinars. So we've organized today's session into 6 areas. First, we're going to talk about some essential information about affluent Americans, how they drive the U.S. economy. Then my colleague Jesse is going to spend time talking about the current mood of affluents and their expectations for the coming year, really and touching on the differences in perspective dependent on who you are, what your characteristics are. And as a hint, not all affluents feel the same way or act the same way. Jesse's going to continue to talk about expectations for spending across the year, where we anticipate that we're going to see increased spending and where we expect spending to slow down. And then I'll come back and talk a little bit about how affluents approach their finances and what their investment strategies are for 2024. And then finally, we'll try to summarize everything into a few key takeaways for everybody. So we've got a lot to cover, so let's get started. Now, we've been focusing on the highest earning households for almost half a century. And there's all sorts of good reasons. They're wealthy, they're opinion leaders, they're involved, but honestly, it's all about the money. And that's why they're of interest to virtually every marketer. But let's talk about just how much money they control. So we look at the Federal Reserve data on a regular basis. And according to the quarterly data from Q3 of last year, the top 20% of income earning households in the U.S. have more than $100 trillion worth of wealth. If you look at this, in fact, these households control 7 out of every $10 of net worth in the U.S. And frankly, as the old adage goes, the rich keep getting richer, and therefore they become more important to marketers compared to the lower income groups. But when we look at these things, these households really do control the lion's share of assets. Whether you're talking about real estate, whether you're talking about ownership of private businesses, holdings in retirement savings, and quite importantly, and we'll get into this in a little bit more, they own 84% of the stocks, equities, the value of the stocks, equities, and mutual funds. And this is really a critical element when we look at affluent households' financial portfolios. And it's one to keep an eye on because we know the big changes in the stock market can lead to both real gains or losses in net worth. But even more importantly, they change the perceptions of affluents as to whether times are good, bad, or indifferent, particularly when it comes to purchasing. So when we break down household net worth by asset type, we really see that for the top 20% of American households, the largest asset category in the Q3 data from last year was sitting in corporate equities and mutual funds. So it accounted for 28% of the total net worth, or excuse me, the total assets of affluents. Now, another 23% of the value of the affluent assets sit in real estate, and that's essentially their primary home. And while they certainly have benefited over the past few years of real estate price increases, when we contrast their ownership to that of the lower income quintiles, what we're seeing is that the lower income earning households, their assets are heavily weighted to the value of their home. And there are 2 points to make here. One, that affluent households have access to greater funds that are more liquid in nature compared to those non-affluent households. And two, that the huge proportion of assets sitting in the stock market. Well, given that, it's really important to watch the market as it really is just a huge indicator of affluence outlook. Now, as everybody knows, the stock market has been doing incredibly well. It's been hitting record highs, and that's a good thing for affluence. And Jesse's going to talk a little bit more about that shortly. Now, at the same time, we've talked about assets, so let's talk about debt. Affluent households do hold 49% of the outstanding debt among all U.S. households. But when we delve deeply into that, the good news is that for affluent households, the debt to asset ratio, so when we look at debt versus their asset holdings, it's relatively low. So the debt for affluent households is roughly $9.4 trillion. But remember, that's against roughly $110,000 in assets. So that equals a debt to asset ratio of about 9%. Now, the other bit of good news there is that 3/4 of the affluent debt is associated with lower interest and tax-deductible home mortgages. Less than $1 in $5 of affluent debt is in higher interest consumer credit. So, contrast this with the other income quintiles, where we see that their debt to asset ratio is twice as high, and the much larger portion is associated with high interest credit card spending. So, this is partly why we saw in the past that affluent households were less reactive to rising prices and high inflation, certainly over the last couple of years. All right, so affluents have lots of money and their debt is relatively low. So, so what? Well, the reality and the really good news is that they're not afraid to spend money, and they spend big. They propel the U.S. economy by spending 2.5 times what non-affluent households spend. And that's really across categories. They spend significantly more than non-affluent households across virtually every category of consumer spending, not just luxury. So whether you're talking about alcoholic beverages or whether you're talking about entertainment, affluents are spending significantly more than those other households. We're just to focus on alcohol. We see that although they represent only 1/5 of U.S. households, affluents account for $1 out of every $2 spent on alcohol. And that is really why this group is so critical for every marketer. So anyway, I've explained why people should care, and Jesse's going to take you through the core of our research, our recent research on 24. So over to you, Jesse.
Thank you, Tony. So now that you know what's going on to affluent consumers, let's go into what's going on with their minds. It's not surprising, biggest topic of conversation for affluents around 2024 is going to be the election. The political climate in the country is going to shape this year. There are strong sentiments coming from all sides. After the last presidential election, we saw an inversion of affluents' perspectives on the soundness of the economy, whether the country is heading in the right direction or wrong direction, depending on their political leanings. And we kind of expect that to happen next year if things go the other way. As the year progresses, it will be important for us to pay attention to how affluents are feeling, especially if there are any changes in consumer confidence or spending. In that vein, despite inflation slowing, it's still very much on the minds of affluents, and perceptions are often shaded by politics, with some individuals predicting an economic downturn, whilst others are hopeful for recovery and stabilization. Both affluents and non-affluents mention financial goals, including paying down debt and earning more through though affluents focus more on saving more and investing wisely, while non-affluents express more hope to better their financial management. For affluents, both men and women express the desire for financial stability and growth, but men seem to focus more on the income increases and investing, while women often mention specific financial targets like paying down credit cards or saving for retirement. Both groups had high focus on health and wellness, but differed in their approaches. When affluents look at health, they often talk about fitness goals, such as exercising more, eating healthier, while non-affluents were more likely to be talking about managing chronic conditions. Not surprisingly, both groups talk about losing weight, and as we've all been there for New Year's resolutions. Even within the affluent population, women seem focused more on holistic health and balance in their lives, while men often mention specific physical goals like weight loss or quitting smoking. Both affluents and non-affluents set goals related to personal development and growth, travel, fostering a better family environment were important to them. But two key areas of difference for affluent focus were establishing a better work-life balance, particularly among women, and for planning for a comfortable retirement, which we don't like. So we've been asking about how affluence last year was and what they expect for next year for several years. Obviously, we show you this chart every year, if not more. Last year, when we presented our mid-year, you can see that those mid-year reports are, this year's been going okay and will go okay for the rest of the year. So it's a little bit on a shorter time frame, but you can see the positivity is kind of back for the affluence there. Next year's optimism remains high across the board. As always, we get to the more macro questions. Affluents are less optimistic. The micro, me, my career, their company, their family, they're always much higher than those U.S. economy, America as a whole numbers. But we're seeing positive expectations for the year, or better than last year expectations for the year. This year was the first time we actually asked about the global economy. We did not add it to this chart. It does follow the trend of like 25% said last year was good and 37 are showing optimism for the year ahead. And we'll get back into the political parties in a bit, but I wanted to note that Democrats are currently consistently slightly more optimistic and said 2023 was a good year for, or 2024 will be a good year for, at a slightly higher rate, but it wasn't that different. They were all pretty much in line with each other. New Year's up, that's the same slide. 2023 was overall, as Tony said, a positive one for the U.S. stock market. This usually leads to affluent optimism, as we saw that's where a lot of their money is tied up. 1 in 3 affluents expect their investments to grow significantly in the coming year. So they're looking for very optimistic. And we're seeing optimism about the economy moving forward. You can see that there's even a little bit of a gap widening between the optimism and pessimism for the next year. It was 47 and 32% in January, and it was higher among the highest income and the high net worth respondents. So here's where we get into some differences. Affluent women are far less optimistic than affluent men. So, we wanted to look into this because you're seeing even with the pessimism being about the same, you can really see the 16-point gap in optimism there. So we went back and looked, and this just goes back to 2021 on the optimism and pessimism for the U.S. economy. We don't have direct casual evidence about why women became so negative about the economy when looking at the events of the Supreme Court after the Dobbs case. You can see a big widening and a negative movement for women around Q2, Q3 2022 when that decision was made. And now we're getting into a plurality being optimistic, but we're still below 40% of women being optimistic for the US economy, while men are over 50%. Nearly all affluents say their net worth has increased or stayed the same in the past year. And men are more likely to think theirs increased while women said it stayed the same. We're seeing these differences between men and women, and we don't really know exactly why, but we're getting into kind of reasons why their thinking may be different. Here, I'm going to show you the numbers among the total affluent population before we dig in a bit deeper. Inflation is still the #1 issue facing the U.S. among all affluents. It's pretty much evenly split between men and women. Heading into the election, immigration, war, healthcare, and political polarization were showing increases, while the economy generally and the environment and abortion and taxes are going down as top issues for people. When we look at the most differentiating issues, you see that guns, abortion, morality, and education are bigger concerns with women, where with men, they're more likely to be worried about immigration and terrorism. But as you see right in the middle of those big word clouds, inflation is really the big worry for everybody right now. We have a new tool at Ipsos. We have a proprietary AI bot called Ipsos Facto. We took a lot of our open-ended responses from our barometer and sent them through and let it spit out and see what they were saying. So this is kind of when we asked about the goals and resolutions for women and men. This is women are less optimistic, as we've seen in the other data. I do want to make sure that I've mentioned that we do go through the open ends ourselves as well to make sure that we agree with the output from the AI bot. Tony made me say that. But none of this should come as a surprise after the last few slides. These are kind of the same things that we were seeing. And then when we go to men had the overall optimistic output. They have more health and wellness goals, are looking for their personal development and the financial stability and prosperity. We ask everybody, do they think the country's on the right track or going in the wrong direction? And then we always have the follow-up question to that of why did you say that? And we threw those into the AI bot and saw what the generations came out with for this. And this was kind of interesting to us. Gen Z is really worried about their economic future. Even the Gen Zers who are affluent don't really see that jobs aren't paying livable wages. There are some Gen Z affluents who are still living at their parents' affluent households, but there are also high achieving Gen Zers who are affluent as well. Millennials, they're worried about the environment. Millennials are kind of entering a phase of their lives with, home ownership, kids, worried about the environment is a big concern for them. Gen Z or Gen X, has the social and moral issues. they're kind of moving into a empty nesting, and they're older children, so their concerns are different than millennials, especially on like what their children's actions and how that affects them. And the older generations, the affluent boomers and seniors, just seem to be over all of it, and I don't really know who can blame them. When we look a little bit more between the generations here, the top, as we saw with the sexes, with the generations, you see that inflation is big among millennials and Gen X, and less of a concern to the boomers and seniors and Gen Z, who may not be in those kinds of phases of life where the inflation affects them as much. You see that immigration is a big issue to the boomers and seniors, and healthcare and the environment pop up very big for Gen Z. Now, as we get into the politics of it, 86% of affluents are already registered to vote in this year's election. 7 in 10 say they're completely certain they'll vote in this year's presidential election. This isn't very surprising. Affluents are usually pretty good about voting. The figures are fairly similar when we're talking about Democrats, Republicans, and independents. But in the concern for maybe Democrats, barely half of Gen Z and millennials are completely certain they will vote, compared to more than 90% of the older generations. Finally, looking at the issues facing the country, again, on what matters more to Republicans than Democrats, you can see that immigration, inflation, and election integrity, these aren't huge surprises to people. Immigration is the biggest differentiated issue that favors Republicans. And then when we go to the Democrats, you see that, guns, abortion, environment, racial, and again, nothing that really surprises anybody about things. The one thing that I do have to mention is that inflation number for 27% of Democrats is still the highest issue, the biggest issue for Democrats. So it's still very much top of mind. Moving on, let's talk about flexing their spending power a little bit. As we like to see, 65% of affluents think that now or soon is going to be a good time to make major purchases, as you see there, home appliances, furniture, cars, hundreds or thousands of dollars purchases. And then we broke this out on generations, and a few things stood out here. Half of the millennials are ready now to make major purchases. As I said, these are people who might be buying their first homes or starting and growing families. Gen X and the older affluents are more likely to be putting off major purchases. Again, these are people who are probably live in the home that they own, and they're a little more set in those lives and are saving for retirement phase. And then Gen Z gets very interesting to me, with nearly half in that soon zone. Gen Z affluents are really starting to differentiate themselves from millennials. And here's one of the spaces that we're seeing it. Their salaries are starting to grow. They're not necessarily married. They don't necessarily have children yet. So they might be getting closer to those things and thinking that's why soon will be the right time for them. But the Gen Z being primed to spend a lot of money should come as a big welcome. I like this chart. We're seeing a lot of signs of pullback on things here, like dining out or home improvement and apparel. And we're seeing increases in spending expected for groceries and vacations. Those are places where inflation is probably more of a concern, especially with groceries. A lot of people are still getting into more and more travel, and travel has been more expensive this year. So they're expecting that to cost more. or in my case, my daughter's turning 2, and now we have to pay for a seat on the plane. And with that, I will hand it back over to Tony.
Thank you, Jesse. So let's take a look. I'm amused that you now have to pay for a seat for Natasha. So at least you won't have to have her sitting in your lap. And let's take a look at the financial approach that we're expecting Affluents to take in 2024. The good news is that when we look at this, most Affluents are really deeply involved in their financial situation and the outcomes. So when we look at this, it's more than 8 in 10 Affluents say they take a great deal of personal responsibility for their finances. 45% of us tell us that they develop their investment strategies within their household. So they either do that by themselves or with their spouse. About a third of them are telling us that they consult with a financial professional, but then they ultimately make their own decisions after weighing the advice from professionals. And this really ties into the almost universal belief among Affluents that people are personally responsible for their own retirement. So there's a sense that they have to take control in order to be able to take care of themselves as they age. But here again, we see a sharp difference between men and women when we ask them about their level of involvement in household financial decision making. So women are much more likely to say it's a shared decision, and men are much more likely to say that they have the final decision. And this is really interesting dichotomy, since most affluent households are made up of men and women, married men and women together leading the household. There's not a great explanation other than to chalk it up to men assuming they're in control, but women really knowing that they are in control, but they want to sort of let the men feel okay, which is probably why we're seeing this sharing, this sense of I'm sharing responsibility. Now, not surprisingly, we do see differences, again, in attitudes about from men and women when it comes to finances. So men are more likely to say that they're actively involved in finances, but the majority of women say that they are actively involved. They're also actively involved. And just like the old saying, or not saying, but the typical men not being willing to get directions on how to get someplace, fewer men admit to turning to others for financial advice. And often what we do find when we talk to women about where they're getting financial advice, we often find that women feel less secure about getting financial advice from professionals, and typically will look to family members for financial advice. Now, the good news is that the majority of affluents are willing to take at least moderate risk with their investments. However, the richer you are, either through income coming in currently, or through your overall net worth, the more likely they are to take higher risks with their investment portfolio. And that's simply because they have a safety blanket. They have insulation that's going to protect them if something happens, if the market has a downward turn, or if an investment turns out to be a poor investment. As an outgrowth of really both the general characteristics and also the fact that affluent men tend to have higher incomes in general, both personal incomes, and tend to live in households that have higher household income. They also have higher net worth. As a result, men are much more likely to say that they're willing to take higher risks with their investments compared to women. And as we showed you earlier, those high net worth households are certainly much more willing to do that. And now, on the other hand, one of the questions we do ask is, how do you think of yourself? Do you see yourself as a saver, or do you see yourself as an investor? Women are far more likely to see themselves as savers. Men are far more likely to see themselves as investors looking to take risk much more than women. Now let's take a look at the investment strategies that Affluent's going to pursue this year. So, the market continues to outperform. The majority of Affluents are really looking to continue those investment strategies that led them to a growth in their net worth over 2023. As we look at this, we do see that 1 in 4 are planning to be more aggressive with the investment approach, really in order to take advantage of the upswing in the market and to further grow their nest egg. Interestingly, those with the highest levels of assets are more than twice as likely to say that their approach in 2024 is going to be more aggressive this year, really as the fact that they anticipate a continuance of a good returns from the market. That leads into, or that really stems from, the optimism chart that Jesse showed earlier. So in all likelihood, the rich are going to continue to get richer, provided that the market continues to produce the kinds of returns that we're currently seeing. So, not surprisingly, when we look at the changes in investment strategies, one of the things that we do see, particularly as affluents are changing generations, is that the largest group is planning to increase retirement savings and contributions. So a lot of this is really centered around people who are getting close to retirement and realizing they need to catch up. But we do see that 38% are saying they're going to increase those savings or contributions, maxing out their 401ks. About 1 in 10 on the other side are planning to invest in non-traditional financial instruments. So these are things like cryptocurrencies or NFTs, other methods of potential fast asset growth. These things tend to be focused very much among millennials and Gen Zs versus boomers and seniors. Oops. I went back. There we go. I don't know how I did that, but all right. Anyway, for a number of years in this annual outlook, we've been asking people in an open-ended question about the financial institutions that they trust most, and then ask them why. So for as long as I can remember, Fidelity has been the top or the primary named trusted financial institution. And that really isn't surprising, given that for many people, their relationship with Fidelity has had a halo effect because their companies have chosen Fidelity to manage 401ks. So for so many of them, that relationship and that building, that confidence building, comes from the relationship with the 401ks. But interestingly, this year, we're seeing increases, higher numbers for traditional banks like JP Morgan Chase, Bank of America. And Vanguard has actually this year received fewer votes than previous years. Now, among the reasons when we ask people why, among those reasons that they gave us for why they trusted these financial institutions, the major reasons were the level of trust was associated with, first, excellent customer service, so that many affluents really trusted those financial institutions because of the outstanding customer service they were getting. They included things like easy to reach, providing clear, straightforward communications, having long-term relationships. Again, that goes back to the 401k side of things. And, in addition to all of that, there's the product and service quality. Now, one of the things as we continue looking at the differences between men and women, it was rather interesting to see that when we asked this question, and separated by men and women, we see that Fidelity remained the #1 most trusted financial institution for men. However, when we look at the responses for women, what we're finding is that more traditional banks are rising to the top. And in fact, JP Morgan Chase was the most trusted financial institution among female affluents. So our big question was, well, why are there differences? And some of that is that, women have told us that they trust these financial institutions based on positive experiences that they've had in the past, as well as the overall reputation of the company. For women, they value long-term relationships. They value honesty, straightforwardness, and reliability. Men appreciated the long-term relationships as well, but they were really focused more on the quality of financial products, the services, the performance of those, of the advice that they were getting and the investment advice they were getting. Women often mentioned emotional factors, so things like comfort and security much more frequently, while men were really focused more on the practical aspects. So what were the fees? How were the returns? The institution's performance. Now, the other question that we needed to know is, okay, given where we are today, what are the issues that could potentially impact your finances in 2024? And again, inflation is coming into line, but there still is this overriding perception that inflation is a big issue, that it could have a negative impact on affluent finances. But as we talked about earlier, the higher one's income, so when we separate out the mass affluents versus the ultra affluents, looking at 125,000 to 249 and 250,000 plus in terms of household income, the higher your income or the larger your nest egg, meaning household net worth of $5 million or more, they become less worried about inflation. And for them, volatility in the market becomes the largest issue. And again, that's no surprise, as we saw in the earlier data, when the largest holdings or the largest portion of your assets is sitting there in stocks and equities, you're going to care about the market volatility. But as you can see, as we look through this, there are the typical things. People are concerned about government politics. They're concerned about rising interest rates, even though the Fed is now getting prepared to start to lower those, but there's still that fear. And healthcare costs. What is interesting, of course, is as you look at the difference here, even though there's that same pattern about the mass affluence versus the ultra affluence or the high net worth, that is also tied into issues about age. So that those higher income or the higher net worth can have better insurance, better health care, so on and so on. But as we looked at it, it's important to watch the market as an indicator, because it really does give us a sense of affluent's willingness to continue to spend or potentially pull back on major purchases. For right now, things look pretty bright. I know that we always do this. We present a lot of material, and we're going to try to summarize this into some key takeaways for everybody. So we do see 4 important themes that are coming from this year's Outlook. And perhaps the most important in my mind is that optimism is back, baby. We see a definite correlation between economic performance, stock market increases, and that impacts the overall mood of affluence. But of course, that said, we know from the data that optimism is not evenly spread, whether you're looking at gender, whether you're looking at income strata, or whether you're looking at generation. So it's really critical, as we talk through these things, that marketers really need to narrow the focus on the nuances that are separating these groups, in addition to looking at the common ground that brings them together, the fact that they are earning more, the fact that they're spending more. We believe that spending will increase, particularly as affluents are really flush with cash, and given the relatively low debt to asset ratio and the fact that the debt servicing is from relatively low interest rates. As we saw in post-pandemic spending, affluents were not afraid to splurge on the things that were near and dear to them. So, whether it is spending more on vacations or willingness to spend more on groceries, and even when we look at things like home improvement, yes, there are more people who are saying they're going to spend less than there are people who are saying they're going to spend more. The fact is that the vast majority of them are planning to spend at least the same, if not more, than they did in 2023. So things are good there. The third point is really, we've got to keep our eyes on November. We know that affluents are really closely watching the political landscape. We know that there are differences in perceptions based on who is in power. And we, as Jesse pointed out, there was a flip-flop after the 2020 elections. We could see that prior to the election, that Republicans were much more optimistic. As Biden came into the White House, all of a sudden it was this flip-flop where Republicans were much more pessimistic, Democrats were much more optimistic. That in turn translates to how they spend. I think that the affluents, again, even though they're a minority in terms of the total American population, the fact is that they're in positions of power and influence. They're going to likely have an outsized impact on over the coming months in terms of both their attitudes and their impressions, as well as fundraising. So, which really takes us to the fourth point, which is that money talks. These are the people who control the vast majority of the nation's wealth. They move markets based on their spending power, and as far as we can see, they're going to continue to grow wealth, particularly if the stock market continues to build on its performance. So the reality is that affluents are going to be flush with enough money to continue spending at the levels that they have been spending. They're going to continue to be the economic drivers for the U.S. So we're going to continue to see them outspending non-affluent households, and that's one of the reasons why we stay. We monitor them, we stay on top of them, and we look for indications as to whether or not things are going to change over the next few months. So we want to thank you all for sitting through the presentation. We hope we've given you some wonderful insights to take, and if there are questions, we'll be sure, if we're running short on time, we'll be sure to respond to them through email. But again, thank you. Have a great day on behalf of Jesse, myself, and the entire team. And over to you, Ellen.
Wow, I am a little overwhelmed by all the amazing data that was shared today, and I really appreciate Jesse and Tony for your time. Thank you all for joining us. Do be on the lookout for a link to the recording, which should be available before the end of the week. In the meantime, we're always here to answer your questions directly, so do please reach out to us. That now concludes today's amazing webinar. Have a wonderful day, everyone.
Thank you.